I was looking at your website, and you talk about advocacy at HOOPP, and there were 5 drivers of that. And I think maybe this is a good framework for thinking about this conversation.
Yeah.
The 5 drivers you talked about were savings, fees and costs, which we already mentioned, investment discipline, fiduciary governance, which is what you were just mentioning, and then risk pooling. I want to go through those one by one and then sort of get a sense of how much that makes a difference in terms of how much I, as an individual, need to save if I were to be with a defined benefit plan like HOOPP versus if I were trying to replicate that on my own.
Yeah.
So let's talk about the savings and how people save and why that's one of the 5.
So one of the big items actually is savings patterns and what we see. So if you're in our plan, it's taken off your paycheck every 2 weeks, and it's automatically goes. So people don't even notice it. So that's what they just live off their take-home pay, and it's automatically taken off, and they don't have to think about it. And the other thing is it's locked in. You can't take it out.
Right.
What we see in individuals trying to do it on their own is it becomes an afterthought. They're dealing with their kids' education, cars, paying for their house, and at the end of it, do I have any money left to save? Well, if I do, I'll put some aside. And here we have an instrument called a registered retirement savings plan, which would be similar to your IRAs, right? Mm-hmm. So the IRA, so the deadline's February 28th. People rush in February 27th to the bank and put whatever it is and buy the flavor of the day, right? So so it's not no real thought given to what you should do with the money, and they put in whatever they happen to have at the time, which is usually very inadequate to provide you with a decent pension. And the other thing you see is that when they have a crisis, a financial crisis in your life, that they withdraw the money. So it's interesting when you look at the stats that people that have been in individual savings accounts. I mean, most of them have absolutely no money at time of retirement. So it's not just they don't save enough; they don't save at all.
Right.
And so people get to unless people are in workplace pension plans, they just and that can be it doesn't necessarily have to be a DB plan, but if in a workplace pension savings vehicle, they don't save at all.
Right.
And so And unfortunately, what we've seen in the last few years is this trend away from workplace savings plans, and we need to think about ways to sort of stem that tide and move things back in the other direction.
Even though I want to go through these stepwise, when you mentioned the fact that we've seen this move away, the immediate thing that I think about is what you told me about the accounting issues and why this happens. I mean, I want to go straight to sort of the solutions thing here, because basically, the solution is defined benefit, is my understanding, and what we're already talking about in terms of savings on a regular basis. But the reality is that in a private company, it's not on an accounting basis a good thing to have that on your balance sheet. Like you mentioned GM in particular as an example of that.
Yeah. So, and this goes back to the Sarbanes-Oxley legislation, which happened after the Enron and WorldCom bankruptcies, where they had all these off-balance sheet entities that masked a bunch of risk that was there. And so, that legislation essentially said you had to put all these things back on your balance sheet, which included the defined benefit plan. So in the past, the defined benefit plan was kind of a one line in there. It was off the balance sheet. But, just if you get swings in interest rates, you can get very material swings. You've got, 50-year assets there that, very small changes in interest rates, for example, can change the value of it a lot. So once you get that back on the balance sheet in the earnings statements, it creates a huge amount of noise. And so companies have big pension plans, and GM is an example of that. I mean, I think the pension plan's about 5 times the size of the company. The pension plan affects the earnings more than anything. And so, the kind of the joke in the financial markets is that GM's the pension plan that makes cars, and it's true in a sense, So, if I put my investor hat on and I want to invest in a car company, I look at GM and think, I'm going to get too much exposure to this pension assets, so I'm going to go buy some other car company instead. So there's a huge amount of pressure from shareholders for GM to get out of the pension business.
Right.
And so that's where it comes from. If the accounting was not that, if you went back to the previous accounting, that probably would alleviate that issue. But employers are looking to have defined contribution accounting. In other words, all they have to put in their earnings statement is the contribution they make in the employee's account that year, and then any future risk is the employee's issue.
Right.
So the risk doesn't go away. It's just got shifted off the company's book to the employee's book.
You use defined contribution accounting, though.
Yes, our employers do. The reason is HOOPP is a different structure. So we don't just manage the money on behalf of the employers. The obligation for the pension is actually HOOPP's obligation, not the hospital's obligation. Mm-hmm. So effectively, we don't only take on the management of the money, we actually have the pension is guaranteed by HOOPP. It's not guaranteed by the hospital.
Right.
So from the hospital's point of view, they really just make a contribution into the plan. And the only future obligation they could have is we could raise the contribution rates.
Right.
But they have no obligation in the future to fund, like if we had got into a situation where we're underfunded or something, they have no future obligation that way. So their accounting is DC accounting. So our structure actually is an interesting structure that could be brought into the private sector that may encourage people employers to get back into something that looks more like a defined benefit plan.
And so you're talking about a governance right there. So let's unpack that a little bit, because we have on the one hand the fact that you can have your constituents have defined contribution accounting, and that takes away this whole accounting issue. But at the same time, they have no control over the governance of how the plan works. How do you achieve that?
Well, they do have some control in the sense of our board is constructed of so the trust. So HOOPP is a trust, and so it was originally created by an agreement between the Ontario Hospital Association, the employer, and 4 founding unions, which is OPSU, QP, OPSU is Ontario Public Service Employees Union, Canadian Union of Public Employees, SEIU, Service Employees International Union, and Ontario Nurses Association. So that's the 5 founders of the trust. And so the employer side appoints 8 board members in each of the unions appoint 2. So it's kind of half union, half management, if you will, at the board table. So they do have some level of control over it. Trust law requires, though, that they all check their hats at the door and they do things that are in the interest of the members of the trust.
And who are these individuals in terms of their competence as from a financial perspective? What do they do? What is their knowledge about pensions and things of that nature? So
it's mixed. So we have some people that I would consider financial experts on the board. Mm-hmm. And some people that are senior members of the unions, for example. But it's a good mix, because essentially, the union people represent the interests of the members, and so you get to understand things from the members' point of view. And plus, we have some financial experts that sit on the board that can provide expertise at the table. And we also have hospital CEOs, for example, on the board that that represent the interests of the employers. So there's a good mix there, and it does lead to good decision making. So it's I think most people would call our board a lay board. Mm-hmm. I think that's a bit of a misnomer, because they're all very intelligent people, well educated, and their day job is, in a lot of cases, not in the financial services sector, but a lot of them have been on the board for a long time. They're familiar with the issues. They're up to speed, and so it's not. And the decisions do get made in the best interest of the members of the plan. So it all works. And you'd think that maybe you'd have all the unions lap on one side of the table and management on the other side. That's never happened. So we have a dispute resolution mechanism that's never used. It's never been close to being used. So people actually do act very much in the interest of the members. So. And I say to people, if you were a fly on the wall in our board meeting, I think you'd have trouble telling who is the union rep and who is the management rep which is how it should work.
Right. And the key for me in terms of that is the ability for these hospitals, even though they're not necessarily publicly traded companies, to use defined contribution, defined benefit, or defined contribution accounting, because legitimately, if you take that issue away, then the opportunity for private companies to use defined benefit solutions increases. Instead of what you were saying, that we're actually moving away from that, you could actually have people move towards that because suddenly they can offer that to their employees, and that's a safety net that people would want.
Yeah, no, so it's just again, it moves you away from the sort of, we're trending very much more towards individual managing their own plan, when it's much more effective to have collective plans, and that you want to try and move the trend back in that direction.